The latest figures from the Commerce Department show the U.S. economy grew at a solid rate in the final 3 months of 2011. The 3% annual growth rate was the best pace in a year and a half. But what does it mean for the first quarter of 2012, which comes to a close tomorrow? Let's ask two of the best in the business. Joining us from Lexington, Massachusetts is Nigel Gault, chief U.S. economist for IHS Global, and here in the studio, Bloomberg senior economist Joe Brusuelas. Gentlemen, thank you both so much. Nigel, let me start with you. Today's numbers show steady growth at the end of last year. What can we read into that for the January through March quarter, which, as I mentioned, ends tomorrow?
Yeah, well, the fourth quarter numbers still show the same picture that they did really at the outset when we first saw the fourth quarter a couple of months ago, which is pretty good growth, 3%, but a lot of it generated by a rebound in inventory accumulation after a soft Q3. That contributed almost 2 percentage points to that growth rate. If we look forward into the information we've got so far for the first quarter, without that big kick from inventories, it looks like we've slowed down somewhat. We're looking at growth overall for GDP around 2% for the first quarter. So we haven't taken off, if you like. 3% is not the new norm now.
No, Nigel's right about that. The inventory restocking accounted for 2/3 of all growth in the fourth quarter. If you look at real final sales, which is a much better indication of what's going on out there in the domestic economy, it increased at 1.1%. I've got growth tracking right now, and it's still early in the data cycle during the current quarter, at 1.5%. So we'll do well to get to Nigel's 2% forecast for the first quarter.
Yeah, Joe, talk to me about the expiration of that business tax credit at the end of 2011. How did that impact investment in, say, new machinery and in equipment?
That likely artificially boosted fixed business investment. So we should expect to see a little bit of a payback as the policy expires in the current quarter, and that'll be another drag on growth.
Nigel, there was some strong hiring that was going on in the first couple of months of this year, but as you know, wages still remain flat. Talk to me about the impact that is going to have on consumer spending.
Well, the evidence on consumer spending seems to be we're going along at around a 2% rate. It was around 2 in the fourth quarter. We're looking for around 2 in the first. Now, we'll see some numbers tomorrow, consumer spending for February. To get up to 2 for the first quarter, we do need to see quite a nice bounce in the February numbers. We think we'll see that tomorrow, but that's certainly not assured. For the consumer, decent growth in employment, but they've still got a lot of debt overhang. Housing is not in good shape yet. And they are coping with these rising gasoline prices, which are going to hurt them more in the second quarter because we don't have the warm weather help on utility bills that we had in the first.
And Joe, the wages, the stagnant wages, that's been a concern for a lot of people for a long time. And then when you see the rising gas prices, a lot of people have been saying that's a de facto tax because whatever comfort that consumers were starting to feel now on their way to work, to commute to work, they're getting hit in the pocketbook once again. That's
right. You nailed it. It's commuters. Here in the Northeast, we take public transportation, but in the rest of the country, they drive in some cases 40 to 80 miles one way just to get to their job. And that's a hidden tax, and what happens is it ends up in a net reduction in discretionary income, and that's not what we want to see at this cycle in the economy. What we need is to see gasoline prices fall and give the consumers a little bit of a breather as they continue to deleverage throughout the business cycle.
Gentlemen, I'm going to ask you to stay put, and we're back with Nigel Gault, chief U.S. economist for IHS Global, and Bloomberg senior economist Joe Brusuelas, our economic roundtable. Joe, let me start this one with you. Labor Department today reporting number of people seeking unemployment benefits fell to 359,000 last week. That's the lowest level in 4 years. Talk to me how might that correspond to the level of hiring that we're seeing in March. Another solid month, perhaps?
Well, we should see a fairly decent month of hiring. I think when we're talking about jobless claims, there's two things you want to keep in mind. One is that we've seen a slower pace of firing, and that's the key, because right now that slower pace of firing has resulted in consumers feeling a lot more secure about their own job situation and their own personal financial situation, and that's bolstering consumer confidence despite the rise in gasoline prices. You saw that Bloomberg Consumer Comfort Index released at 9:45 this morning. That increase, and that is good news.
Nigel, the president of the Philly Fed, Charles Plosser, he was at a forum today in Wilmington, Delaware, and he said that the Fed may need to raise rates before the end of 2014. If job growth continues to remain steady and inflation remains tame, is the Fed going to take that action?
I think the Fed's more likely to be staying the course, or at least to be following the guidance presently given by the FOMC. So I think it takes a bit longer than planned. So I'm maybe a little less optimistic than he is on how rapid job growth we can sustain. I suspect that we may see some slowing in job growth later in the year, because I think it's running faster than the GDP. I think inflation will be quiet, right, but I think the Fed will be on a little longer than he does.
You know, Nigel, don't you think that the Fed's really in a difficult situation here? Because the unemployment rate's going to, even if it improves, it's going to improve in a very slow fashion. And what it really comes back to is we've got this depression in the housing sector. We've got 3.9 million in the shadow inventory, potential 6.5 million that may come to market over the next couple of years. If the Fed does anything, it's probably going to have to buy mortgage-backed securities to compress spreads in order to begin blowing out that blockage in the housing market that's really stuffing up the lines of liquidity.
Yeah, I agree. That's the most likely next step for the Fed. They'll be doing that rather than raising rates. And I totally agree that if you're thinking about what do we need for the economy really to kick into higher gear, we need housing activity to start to come back. And at some point, it's going to come back in a big way, because we're a long, long way below demographic norms for housing starts. But it's not just around the corner.
Nigel, we were talking about oil before the break. Crude was down today. That drop coming a day after France's government said that it's optimistic Western nations, including the U.S., would release emergency crude stockpiles from the strategic petroleum reserves to help offset that rise in energy prices. If the SPR is tapped, how are the markets going to react?
Well, clearly the possibility of the SPR being tapped, it pushes prices down. Actually tapping it, the event, of course, you know, on the day that occurs, that's going to be knocking the prices down. But if you look at what happened previously last year, the event was a very big deal, but pretty soon the prices had moved back up again when people compared, you know, the amount that's coming out of SPR with the potential risks to supply. So I think it has a bigger short-term effect than the medium term.
You know, I think two things. One is that it's useful for the administration to jawbone the oil market and threaten to release strategic petroleum reserve. But it's another thing to actually do it, given the tensions in the Middle East. I have yet to see anybody at the administration come out and say, what's plan B if we release the reserve now and then hostilities break out later this summer? What do we do? So this is going to be an ongoing story, I think, for a good period of time.
Joe, let me let you get the last question, about 30 seconds. Today, the Senate Banking Committee approved and sent to the full Senate the nominations Harvard professor Jeremy Stein and the former Treasury Undersecretary Jerome Powell to be members of the Fed's Board of Governors. It's a presidential election year. What are the chances that this goes through or doesn't go through?
This was a deft move on the part of the Obama administration. They appointed a former Bush party official and then somebody who leans to the Democrats. I think they both sailed through the committees.
All right. Joe Brusuelas, Bloomberg senior economist, and joining us from Lexington, Massachusetts, Nigel Gault, the chief U.S. economist, IHS Global Insight. Gentlemen, thank you both so much. Appreciate it.